Hello, beautiful people. This short video is entitled The Four Piggy Banks. It's a video on finances, and it's based on a book that I'm currently reading. It's called Money, Wealth, Life Insurance by Jake Thompson. And there are amazing concepts that you could use, and you could purchase the book, or you could look at videos on YouTube. Now, my name is Carrie, and I am a registered nurse. I'm also a licensed financial professional. Part of my goal is education. I'm planning to educate others and create content that prepares you to make wise financial decisions, maximize your retirement, and understand tax-exempt investments. As I mentioned before, I'm a nurse and I care for patients and their physical, mental, emotional states. And sometimes you get overwhelmed and you feel helpless. And you see the disparities in our healthcare system. Many patients are older. They have difficulty accessing resources. They are physically, mentally, and financially vulnerable. Now, when I was younger, I thought about retirement was that, you go on cruises, you eat some good food, and just you relax and you don't have to work anymore. But what I found in healthcare is that a lot of people that are older are not only sicker, but they have problems paying their bills, getting rent, food. And according to Forbes magazine, the number one retirement worry is, will I outlive my finances? And this is one of the reasons why I made this video, to educate people about their finances in terms of retirement. According to the US Labor of Statistics, 25.8% of adults aged 65 to 74 are working. And this figure is expected to rise. Some people go back to work because they love working or they're bored, but the vast majority is out of necessity. Now, on the upside, a lot of people are living longer and they're aging better. And this allows them the capacity to work. But if you are living longer, you have the likelihood of running out of finances. And because people are living longer and they have increase in expenses, the Bureau of Labor Statistics also says that adults 75 years and older are working 11.1%. And between 2010 and 2020, that is a 53.7% increase. Now, let's examine where people have their money. So people have their money in bank accounts, around 80%, stock markets, 61%, in retirement funds like 401k, 403b, fixed annuities, and less than 50% in tax-exempt options. Now, only 5% are in well-structured tax-exempt accounts. And we're going to examine all of these in a little more detail to understand how people organizing money helps with their retirement. Let's examine the first place people hold their money, which is bank accounts. The advantage of bank accounts is that it's easy to access funds, it's insured, easy to transfer money, and interest compounds. The bad thing is that there's low interest rate, sometimes 0.01 to 0.06, and the money does not beat inflation because it's currently around 3 to 7%. And because it's easy to transfer, people transfer money out. And sometimes your banking fees could be more than the interest earned. With stock market, there are some advantages. You have high risk, but if you manage it well, you could get high gains, potential for income from dividends and growth over time. But stock prices vary, and sometimes there are crashes, and money is not easily available at times. You have to wait. The pros and cons for retirement fund is that they're tax deferred. Oftentimes they employer match. You have several investment options available within a retirement account, and you could move it to another job as well at times. The bad thing is that they have high administration fees. And the worst thing is that you could lose approximately 50% of it if you withdraw it before the age of 59 and a half. 30% goes to federal tax, 10% goes to state tax, 10% goes to IRS penalty. So if you decide to overfund your 401k, 403b, you may not have to work again and you may enjoy traveling, but the bad thing is that you may end up retiring at a higher tax bracket. And you may have to pay more taxes because when you're older, you have less deduction. The kids are older, they're not in the house, and some people paid on their mortgage. Let's take this guy, Roger, for example. He's saying, I'm good because I have Social Security. I could add to my 401k. The bad thing is that you have to pay taxes on Social Security. Right now, the average check is 1705. Now, what's the pros and cons here? For a married couple, if your income is under 32,000, then you don't pay anything on your Social Security check. But if it's between 32 and 44, it's 50%. Over 44, you pay 85%. For singles, if your income is under 25,000, you pay zero tax. 25 to 34, 50%, and over 34, 85% tax. And this is not a lot of money to survive on for retirement if you have medical bills, food, everything else. So with tax exempt options, we're going to use Index Universal Life Fund as an example here. You could get tax-free growth. So the money that you put in your account, when it grows, you could take it out and then be tax-free. You also have the option to get an interest-free loan from the account. You borrow against the cash value or the policy value. You have living benefits, and also if you pass away, you could transfer this to your loved one tax-free. There's no probate. Now, what are the tax-exempt and tax-deferred definitions? Now, we're all accustomed to hearing taxable, and we understand that we pay taxes on our income, checking, savings, stocks, bonds. Deferred means these retirement accounts where the money goes in without being taxed, but we end up getting taxed when we retire. An exempt one means that the money has been taxed from our account, we put it in these special accounts, and they grow tax-free. And they outperform 401ks. So if your money is in a fixed account, it has a steady, but it may not beat inflation. If it's variable, like the stock market, goes up and down. With index, it mirrors the S&P 500, for example, depending on your account. And every time there's a gain, you get that gain and it locks it in if there's a loss. And then you get another gain and it locks it in. So if you look at it another way, there's a higher growth with less tax. With an index, you pay tax only on the contribution, the money that you're putting in, compared to the old way where you get tax when you retire. And when you're the most vulnerable, you end up getting taxed and end up having less money. So your money actually is worth more in an index account than one of the different options that are available. Now, this is a comparison between a bank or a 401k, a brokerage stock, and an FIA private pension. The IUL has advantages over all of them. There's no probate at the end. There's legacy or wealth transfer. There's coverage for chronic illness. There's so many advantages, but IUL is not for everybody. And you should talk to a financial professional to get as many facts as possible and work within your budget. People have taken IULs and they couldn't afford it, and that's why IUL gets a bad name at times. Now, here's an interesting fact. During 2008 housing crisis, 700 banks received bailout, $245 billion. How many life insurance companies? 6 qualified, and only 2 got money, and they repaid the money back. During the Great Depression in the 1930s, 9,000 banks failed, and there was only 20 out of 350 insurance companies that failed at that time. Now, if you're planning for retirement, here's something you could do. What age do you want to retire? Then how much you want to retire, multiply that value by 12. Consider too, what are your dreams, what are your goals when you want to retire? All of these things help you create this financial plan. Also, you have to consider your debts. What is your mortgage, your student loans, car payments, inflation? Consider, do you have coverage for chronic or critical illnesses? Those are some of the things. Now, when you consider inflation, consider rent, for example. In 1960, average rent nationwide is $71. Today, it's $11.80, and that's being reasonable. Now, if you need like $3,000 a month for retirement, that means annually you'll need $36,000. If you need that money for 20 years, you need to have saved $720,000. So that's a fair amount. If it's 30 years, then you need even more, almost $1.08 million. In our future episodes, we're going to cover some of this in more detail, and you'll understand the rule of 72 and how compounding works, and different kinds of accounts and how they can benefit you. So schedule a complimentary consult. Get some more information so you can make a wise decision. I have done that. My wife has done that. And the people we work with now, We were once clients, but now we work with them, and they're a group of professionals across the United States, and they work with 700 companies. And our goal is to help families everywhere, change lives, and to make a difference, and not just make a living, to help people. Because if we see this problem where people are facing finances, we do nothing, then we're part of the problem. And we're working continually to improve ourselves and our customer service. We're providing exceptional service through clear communication and financial education. I joined this business through the encouragement of my wife. We have personally applied these financial principles over the years, and we have benefited so much. I'm an immigrant and I had to catch up on my retirement. I can safely say that I have caught up, and I feel like I'm in alignment now. So thank you so much for watching. Please like and subscribe, and try and meet with a licensed professional whenever. You could click on the link that's below this video, and we will get someone that will talk to you. Goodbye for now. Thank you.